Today, we're looking at an investment analysis report on SOUN stock, which argues that a recent price drop is a golden buying opportunity based on a disconnect between the price and the company's fundamentals.
And that core idea is really strong. I mean, a high-growth company getting hit by market sentiment, that's a classic setup. But to really make this analysis land, we need to make sure the logic is just completely airtight.
Right. How do we get the reader from strong company to buy this now?
Exactly. So let's jump right into that, into strengthening the core valuation thesis.
Agreed. The analysis needs to more clearly establish the mechanism by which, 68% revenue growth actually translates into these aggressive future valuations it's citing. Because the data it presents is, it's highly compelling. Q3 revenue at $42 million, up 68% year over year. That's huge.
It is. And then you have the balance sheet, which is a fortress. $269 million in cash and absolutely zero debt.
Yeah, powerful stuff. It immediately calms an investor who's just seen a red day.
It does. But here's the gap. The connection between these facts and the exciting price targets.
The 1707 average target?
Right. The 1707 target, which is a 46% upside, and the $15 Cantor Fitzgerald upgrade. That connection is sort of treated as a given.
As an undisputed outcome.
Yes. It's not a logically supported conclusion built on the company's own dynamics. There's a missing analytical bridge.
And that's the critical weakness. It feels like the analysis is just outsourcing its credibility to Wall Street. It's saying, believe this target because Cantor Fitzgerald said so.
Which is fine as a starting point, but it leaves the reader exposed. What happens if an analyst downgrades? Your whole thesis is suddenly on shaky ground.
The analysis has to provide the internal reasoning.
Exactly. We need to integrate some specific forward-looking context to ground those high targets in what the company itself is actually doing.
We need to connect the type of growth to its future significance. 68% growth is exciting for any tech company, but the market is smart. It applies very different multiples depending on the quality of that growth.
That is the key. Is this 68% from, one-time project fees? Because if so, the market will see that as cheap growth, and it won't give it a high multiple.
Precisely. And if you're trying to justify a jump from $11.65 to $17, you are absolutely arguing for a massive multiple expansion.
You have to be. So the reader needs to believe the company has predictable, scalable revenue. The analysts who set that $17 target are almost certainly modeling this like a high-value SaaS business.
With recurring revenue streams that justify a premium.
The analysis needs to show the reader why that assumption is justified. Don't just state the target, justify it from the ground up.
So, a concrete example of how to build that bridge. The report could briefly reference the specific segments driving that growth.
Yes.
Is it heavily weighted toward a new recurring subscription product? If it can say something like 70% of that growth came from a new SaaS contract or a specific long-term customer segment, that future-proofs the valuation.
It changes everything. The number isn't just the number anymore. It's an indicator of future predictability.
Another way to do it is to frame that $42 million in revenue against the TAM, the total addressable market.
Show the runway.
Yes, demonstrate why this growth trajectory can continue. If you can show the reader that $42 million is just, say, 1 or 2% of a huge potential market for their tech,
then the path to $17 feels probable. It feels earned by the company's position in the market, not just a number you've quoted from a bank. It builds real conviction.
Okay, so that brings us to the second point, the use of catalysts, specifically the role of short interest in this whole investment case.
Right. And I want to say the main angle of the disconnect, fundamentals up, price down, that's excellent. It's a great frame. It turns market fear into an investor's opportunity.
But the execution around the short interest could be, let's say, refined.
Yeah, refined dramatically. The core issue is that the strategic emphasis on high short interest as the ultimate payoff, it risks prioritizing short-term technical speculation over the long-term fundamental case you just built.
Exactly. The analysis correctly identifies the 3% drop to $11.65 as the opportunity, but then the outline positions the 30% short interest as the kicker.
The thing that will make the stock rocket.
Right, and when you introduce a massive squeeze above $12.50 as the main way to profit, you completely shift the tone of the piece.
You really do. You go from a value and growth investment, a calculated decision based on that fortress balance sheet we just talked about, to what is essentially a momentum trade.
A trade based on forced buying and technical charts. It introduces this unnecessary perception of risk. You've just sold the investor on stability, cash, no debt, and then you pivot to a high volatility event like a short squeeze.
It completely undercuts the confidence that you just worked so hard to establish with the fundamentals.
Yeah, it's a conflict.
It is. If the argument is strength and value, the reader should feel smart for buying a great company at a discount. If the argument is a squeeze, the reader feels lucky if it happens and, exposed if it doesn't.
So the suggestion here is to reframe it. Reframe that short interest. It's not the primary engine for profit.
No. It should be a secondary confirmation of the market's irrationality. It should bolster that main disconnect angle.
The goal isn't the short-term trade. The goal is making the long-term investment case. The short interest is evidence that the mispricing is severe, not the reason to buy in itself.
Let's think about the behavioral finance aspect of this. A high short interest can actually be comforting, but not because of a squeeze. It's because if 30% of investors are betting against a company that has zero debt and 68% growth,
Then it just confirms that the market is acting irrationally.
exactly. It confirms your core thesis. So the power here is in repositioning that entire segment.
Okay, so instead of hyping up a massive squeeze,
You use that high short percentage as powerful evidence of maximum pessimism.
I like that, maximum pessimism.
You argue that so many investors betting against a stock with a fortress balance sheet is further proof that the 1165 price is a temporary gift, a gift from market sentiment, not a true reflection of the company's value.
This framing also helps explain why the price is so low despite the good news. The shorts are acting as an artificial cap on the price.
Right. You can argue the short position is suppressing volatility, keeping the stock in a nice accumulation range until the shorts are finally forced out by, say, another strong earnings report.
That keeps the focus right where it should be, on the company's strength, not the short seller's weakness.
It turns the 30% short interest from a risky catalyst into a data point that basically screams, this is cheap because other people are making a foolish bet. That is a much more reassuring and powerful message.
And that idea of reassurance leads perfectly into our final point, which is about the emotional tone of the analysis. This is so critical when you're targeting investors who are described as being scared.
It is. I saw in the notes a specific goal for the tone. Urgent but reassuring. And that right there is an emotional conflict. I think it could seriously destabilize the exact investor you're trying to help.
Yeah, the report is for people who panicked when the stock closed at 1165. It's trying to validate their decision to hold or buy more.
But then the introduction uses this really high-stakes, urgent language. Things like you might be making a huge mistake if you panicked.
That kind of energy directly clashes with the confidence that should come from the company's financials.
If the company has 68% growth and zero debt, the thesis is built on durability. Urgency implies the opportunity is fleeting, that the window is closing fast. It contradicts the whole picture of a stable, enduring enterprise.
The urgency completely negates the reassurance.
It does. The analysis needs to be the antidote to the panic, not something that adds to the frantic energy. So the suggestion is to shift the tone toward unwavering analytical certainty, calm confidence.
Let the facts provide the reassurance. You don't need any artificial, FOMO-style urgency.
The confidence should sound like calculation, not hype. Hype makes you rush. Calculation makes you strategic.
The language needs to reflect the stability of a debt-free company.
Not excitement. Think about that opening. Instead of warning about a huge mistake, which is highly emotive,
You could reframe it with a statement of calculated certainty.
characterize that 3% drop not as a moment for panic, but as a temporary mispricing event. Or even better, a low volatility accumulation zone.
Low volatility accumulation zone, I love that. That phrasing is brilliant.
Why, thank you.
No, seriously, because it aligns the language directly with the zero debt profile of the company. It suggests this is a calculated, strategic move, not a risky gamble on a volatile chart.
It makes the investment sound tactical. And when you calm the language down, you allow the spectacular metrics, that 68% growth, the high analyst targets, to really shine without being overshadowed by fear of missing out language. Your words should mirror the durability of the balance sheet.
The language itself becomes proof that smart money takes advantage of emotional drops. And the confidence to do that comes from your analysis.
So